In business tonight, a rout in stock markets right across the globe as investors fear a possible recession given the sweeping U.S. tariffs. Greater Chinese markets deep in the red. Now Hong Kong stocks plunged the most in almost 3 decades. Beijing intervening to help stabilize markets. That's as the rout deepened after sweeping U.S. tariffs. China's sovereign fund central, Huichen, increasing holdings in Chinese stocks. Taiwan's top financial regulator is preparing to impose temporary curbs this week on short selling of shares as stocks fell more than 9% in today's trade. Stocks slid about 5.6% in Seoul. The nation's financial regulator preparing a market stabilizing program worth more than $68 billion. The Nikkei 225 ended 7.8% down with uncertainty growing. Meanwhile, European shares tracked Asian peers, the stock 600 plunging to a 16-month low as EU leaders gather to decide on responses to the U.S. tariffs. It was a similar story for Germany's trade-sensitive DAX and the FTSE in London. U.S. futures pointing to a slowing fall when markets open in New York, with S&P 500 futures losing about 2.5% compared to the more than 5% tumble in the prior session. Here's a look at how stock markets of the world's top 5 economies have fared since President Trump's inauguration in January. For more analysis, we're joined by Florian Weidinger. He is Chief Investment Officer at Santa Lucia Asset Management here in Singapore. Mr. Weidinger, thank you so much for joining us. So it's a gloomy day for the markets. Today's been perhaps one of the worst trading days for Asian equities since the global financial crisis. We saw the Hang Seng tanking more than 13%, Taiwan's benchmark seeing its worst day on record. I mean, were you surprised at all? Were there any expectations that they were going to be this severe?
Well, I think all of us came to the office very early today because we all knew this was going to be an interesting day. I mean, some of those numbers are a bit exacerbated by the fact that the Hong Kong market was closed for the Qingming holiday on Friday. So while the number is big, it does represent a 2-day move, essentially. And then, of course, the other difference to last week was the news sort of after the end of last week that China is starting to retaliate and is playing a tougher game with the Trump White House compared to, let's say, the Vietnamese delegation who sort of almost immediately after announcement sought an accommodation. I think those are sort of the two factors that combine, but really what we're seeing is sort of a combined 2-day market performance here.
Do you see the market stabilizing anytime soon, though?
That's a golden question. I think without thinking too much sort of from one day to the next, I think one of the complications is that contrary to other market dislocations, this really rests with a somewhat discretionary decision by one man almost. And so the market could violently rally again the moment there's a sign of a relaxation of some kind. Many representatives of the Trump White House have hinted that this is a tool that's meant to be temporary. Now, as recent as late last week. However, temporary can last several weeks, several months. If you think about forward positioned inventory, those could be drawn down for a while before goods or tariffed goods would have to be brought into the United States. So these things may not get resolved within days. And so we really need to think about how to position for the next, not just 1 or 2 days, but next few weeks.
I mean, take weeks or months, as you said, with little hope that President Trump would change his tariff policy. And with China having hit back, what kind of retaliatory moves are you expecting from the rest of the Asian economies?
Well, this is the interesting question. I mean, by the way, I think it's perfectly plausible that Trump changes his mind based on whatever he gets tomorrow. That's also possible, of course. But one interesting question will be how close will China stay to its friends? So far, most economies in the world have sort of indicated a willingness to negotiate. At the same time, China has come back quite hard by reciprocating these so-called reciprocal tariffs. And so therefore, China is using a somewhat asymmetric strategy to some of the smaller Asian countries who have been really surprised by these harsh measures. That's in part probably because China feels quite well prepared for this. And I think investors do need to take that into account. China had many years to prepare, and China's exposure to the US through exports is actually much less than most people think it is. On sort of gross export numbers, we're looking at just under 2.5% of GDP. And if you include some transshipment, it's still about sort of less than 3% of China's GDP that is exposed to export to the US. Many people think that number is actually a lot higher, but that's actually not true. Only 15%, 1/5 of China's total exports are going to the United States. And those exports are less than 3% of Chinese GDP. So China feels that they are somewhat in position. They've also announced a fiscal stimulus that by most people's measures indicates a sort of 1.8 or so fiscal impulse year over year. Possibly there's more in the quiver. That's in part probably why some of the consumer and property names today didn't fall quite as far, because some mainland investors are speculating of China's other potential sort of countermeasures. But I think one important reference point here is China is rather prepared for this.
So what about the investors,
and
Mr.
is probably
Weidinger?
thinking of a multi-move game of chess here.
Yeah, well, what about the investors? What advice do you have for them at this time? What would you say is the best strategy for them?
Well, first of all, I think not to make too many illiquid commitments right now. I think staying liquid is important, to stay flexible, because as we're all learning every day, the world can change at any moment. The other thing would be, I think following the security dimension of this is important. The Trump White House and a lot of his advisors care not just about trade and money. Some of the important stakeholders do care about the security element, the military cooperation element. So those countries in Asia that are relevant for that may find themselves in better graces over time. And that's something interesting to watch. For example, Korea on the shipbuilding side.
All right, appreciate your insights, Mr. Weidinger. Thank you so much. Florian Weidinger there, Chief Investment Officer at Santa Lucia Asset Management in Singapore.